Welcome back to EDS, and in this video I'm going to show you step by step how to create your dream portfolio that pays you every day, week, month, year consistently. So the first thing you want to do is navigate over to where you can see a list of things to trade in your brokerage account. And what we're going to be focusing on trading on today is futures contracts. Specifically, we are going to be writing options contracts on futures contracts. So a bit of a double derivative there. And the reason for why we're going to do this is for two reasons. One, we're going to use options. We're going to write options contracts because that allows us to get a high probability of success. And then we are going to be using futures because futures uses span margin, which means that your positions will be very capital efficient and it's suitable for large accounts, small accounts. This is super useful if you have a small account because it allows you to rapidly grow your account very quickly and reliably. So we've just got open a watch list of futures contracts that have options available to trade. So what I personally like to do is order everything from high to low IV rank. We've filtered everything to only show things that have a 3 or 4 liquidity level, although futures are almost always all pretty liquid, so you don't really need to worry too much about that. But as a matter of personal preference, I've got everything ordered from high to low IV rank. This is because we want to sell options contracts or write the options contracts when IV is high and then play the contraction back down to the mean and hopefully further below. So what we want to do is we want to pick something that's got a mid to high IV rank. Anything with an IV rank of over 30 is suitable. So that is pretty much almost everything on this list right now. Let's have a look at the Japanese yen futures /6J. It's got an IV rank of 44.9 and an absolute IV level of 11.7%. So hopefully we can get some nice premium on this position. Now we just want to navigate over to where we can see a list of expiration dates for this underlying. Now there's two expiration dates going on here, two types. You've got the expiration dates of the contracts, of the options contracts, and then you've got the expiration dates of the futures contracts. Now, provided you're using a good broker, everything will be integrated all in one for you. So as you can see here, we've got our option expiration dates here: Feb 7th, March 7th, April 4th, May 9th, etc. And then we have our futures contracts here. So February 7th and March 7th will correlate to the same futures contracts, which will be the 6JH5. And then when we move over to the April 4th and May 9th options expiration dates, we go to the 6JM5 futures contracts. And going into why this happens is a little bit beyond the scope of this video. We're not going to go into it, but provided you've got a good broker, this will be automatically done for you. So you don't really need to worry about which futures contract you're trading. You just want to worry about the expiration dates on your options contracts, because your broker will automatically line everything up for you in the back end. So the option expiration date that we want to go with needs to be between 30 and 60 days out in time. So as you can see here, we've got a expiration date that's 52 days out, which is perfect, and that's the one we'll go with, which is March 7th. So we're just going to open that up, and now we are presented with the options chain. So just very quickly to explain what's going on here, in the middle, going from top to bottom, we have our strikes. This orange horizontal bar shows us where the price of the Japanese yen futures are with respect to the strikes. This vertical orange bar shows us what the expected move is of the Japanese yen over the next 52 days. These dotted blue lines are our 1 standard deviation levels. We have our bid and ask on the call side over here, our bid and ask on the put side over here, and we also have our delta column on either side as well. So we want to be capital efficient, which you'll see that we are capital efficient, and we've made sure that we're capital efficient by picking a futures instrument, or a futures underlying, and now we need to ensure that we get a high probability of success. So what we're going to do is we're going to use 3 different things, 3 things to check off our list to make sure that we get a high probability of success. So a prerequisite to this is knowing how options contracts work, and we are going to be writing and selling these contracts. So what that means is we want prices to stay away from these contracts. We want to write these contracts out of the money, and we want price to stay out of the money. So let's say, for example, if we were to write a contract at 0.0061, we would want price to stay above that if it was a put contract, and the reverse is true if it was a call contract. So what we're going to do is we're going to sell a call and a put, one of each, very simple, and we're going to sell it outside of the expected move, and immediately that will give us a high probability of success. Now, we don't want to go too far out, because the further out you go, the less premium you collect. So you want to find a nice balance, and typically that balance will land you somewhere in and around the 1 standard deviation level. And as a further point of confluence, we can also use delta. So I personally like to be anywhere between a 15 and 20 delta on either side. So if we just go with a 17 delta on the call side, and then we go with a 17 delta on the put side, that lands us outside of the expected move and in and around the 1 standard deviation level. Now what you'll notice is that it's not exactly perfect. We're not exactly right on the edge of the 1 standard deviation level. We are a little bit closer on the put side to the at the money price, or to the current price, and we're a little bit further on the call side. This is normal. This is just called skew, okay? And this is absolutely normal. You just want to use this as a framework, as a guideline, and you should be absolutely fine. And what you'll notice is now we've got this green bar here that's just been created, and what that is, that's our break-even bar. So if price is anywhere within this green bar at the point of expiration, we'll make money. Now if you notice, this green bar overshadows the orange bar, and that's going to give us a high probability of success, because this orange bar, remember, is our expected move. So if we look in the bottom left corner, we have a pop of 72%, which means probability of profit. So we've got a 72% chance of making at least 1 penny on this trade. And if we wanted to get out at, say, 50% of max profit, we didn't want to hold till expiration, which we very rarely hold till expiration. Say you want to get out at 50% of max profit, we have a P50 here. Now our P50 is not displayed for futures for some reason, but for equities it normally is, and generally speaking your P50 is going to be about 10 to 15% higher than your pop. So we'll be looking at probabilities of success between 72 and around 85%, a little bit higher. So already very, very high probabilities of success. Now, what do the numbers look like for this position? So this is what we would collect up front here, 0.000470 in premium. Now, the contract multiplier for equities is 100, but for futures it's completely different. So for all futures contracts it's slightly different, but for currencies it's in the hundreds of thousands. For the Japanese yen it might actually be a little bit more, by a multiple of about 10, but the point is it's in the hundreds of thousands. Futures are very, very big products. These are big contracts, and it's because of span margin that allows us to trade them in a capital efficient way. So you don't need to worry about the contract multiplier, because it's automatically calculated for you here by your broker. So our max profit would be $587.50 on this position, and our broker would require just under $2,000 in buying power to open and hold this position. So as you can see, we've got already, without doing too much, we've already got a very high return on capital. So in 52 days, we're looking at over 25% return. And I'm going to show you how to get an even higher return in just a second. And we've got very, very high probabilities of success between 72 and 85+%. So as you can see, without doing too much effort, we're already onto a winner. And this is just one position. I'm going to show you how to craft your entire portfolio. It's pretty much the same thing. You just do it over and over again. So let's just say if $2,000 was too much for you, you didn't want to have $2,000 allocated to any one position. Well, what you can do is you can just buy another contract. So you can use some of this premium here to buy a contract a little bit further out of the money. Say you just go one strike down, and you go one strike down on the put side as well. Just make sure that the actual spread is the same. So this is a difference of 0.00005. So just make sure that the difference is the same, 0.00005 on either side, because your strikes can be different widths apart for different underlyings. So just make sure that your actual spread is the same on either side. And what you'll notice that we've done here is we collect less premium up front. Our max profit is now 175, but we've now defined our loss to whatever the spread is minus our premium times by the contract multiplier, and our max loss is now 450. However, because of span margin, our buying power requirement is only $213.35. So it's going to cost us, or it's going to take $213. Our broker's going to hold $213 to open this position, and we're going to collect $175 up front. So as you can see, this is now a much higher return on capital than what we were looking at previously. Our probabilities of success do suffer slightly. Our pop has dropped by 6%, but we've still got a pop of 66%, which is extremely high. Anything over 50% is considered a high probability trade. Now, we've got a very high probability of success and a very high return on capital, and now our buying power requirement is about a tenth of what it was before. It's only going to require just a little bit over $200 as opposed to a little under $2,000. And what you can do is you can widen out these strikes a little bit, collect more premium, require more buying power. It just depends on how much buying power you want to allocate. You can be a little bit more aggressive, go to the 21 delta, 23 delta on either side. Say you just want to keep your strikes, your long strikes, nice and tight to your short strikes. Well, now if you have a look here, we have a slightly lower probability of success. However, look at our return on capital. It's basically a 100% return on capital now. So this is how you can find and manipulate positions to place and fit inside your portfolio. Now, all you want to do is simply do this over and over again with different underlyings, diverse underlyings, to create your portfolio. Have a mix of futures, a mix of equities. It works exactly the same way with equities. The only thing that you need to know now is how much buying power you should be allocating to your positions and how to structure your portfolio on a capital basis. Well, in order to figure that out, we've created a free position sizing template that's available for everyone to get a hold of. Link is in the description. Just click the button and it will take you over to the spreadsheet. And the way it works is you enter in the size of your portfolio. Say you have a $100,000 account. You then enter in whatever the current VIX level is, say if it's 18.2. Everything below will then be automatically calculated for you, and it will tell you the maximum amount of buying power that you should be allocating to your defined risk positions, undefined risk positions, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this spreadsheet, over the long run you will be absolutely fine. No one single event will wipe you out. And our edge is in writing the contracts. So we don't need to find an edge in the market. We just need to write contracts in a high IV environment. That's the edge. It's pretty much done and taken care of for us automatically. Our job is to stay in business, and adhering to this template will help you to stay in business. Remember, these are your maximum numbers. So you don't need to, for example, maximum amount of buying power to allocate single defined positions, $5,000 in this portfolio example. That's the maximum. So you don't need to allocate 5,000. You want as many occurrences as possible. Okay. Now, if you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so you can speak with myself directly or with other like-minded individuals. And there's also a 100% money-back guarantee. So once you have studied the full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's £1 a month to join right now. The price will be increasing. It's super cheap because we've just launched. But once you're in, the price is locked in for you for life. So even after the price increases, you still only pay the price you paid on entry. So you are definitely rewarded for getting in early, and the aim of EDS Premium is to get you to a point where you've learnt the skill, you know what to do, you know how to write contracts, you know how to manage risk, make adjustments, and you don't need any external help or influence to do so. You've learned the skill, it's something that you can take with you for the rest of your life. We aim to get you to that point within 6 to 12 months. So you are always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.